When you deposit money into your savings account, you probably picture it sitting quietly in an impenetrable steel room, waiting patiently for the day you come back to withdraw it. But the second you hand your cash over to a teller, your money stops being a passive object. To understand how a bank actually works, you have to invert your perspective. To you, that deposit is your hard-earned wealth. But to the bank, your money is a liability. They owe you that exact amount back upon request, and they owe you an annual fee, usually around 4%, just for the privilege of holding it. If your cash actually sat in a safe doing nothing, it would be an active drain on their balance sheet. The bank is losing money every single day it simply holds your cash. Curious, which raises a rather obvious problem. How does an institution pay for thousands of branch locations, their employee salaries, and shareholder dividends if its primary product strictly loses money? To survive, banks immediately deploy your deposits as the raw materials in a wealth-multiplying factory. Before they can put your money to work, they have to follow strict rules set by central banking authorities. If a bank lent out every single dollar or rupee it received, there would be nothing left if you suddenly needed cash for groceries. To prevent this, the government mandates a cash reserve ratio, meaning banks must keep a strict fraction of all daily deposits physically on hand. Let's look at how a standard 10,000 rupee deposit physically breaks down on this diagram. Assuming a reserve requirement of 9%, the bank locks away 900 rupees to cover routine withdrawals. That leaves 9,100 rupees of liquid capital, their ammunition. The bank immediately loans that 9,100 rupees to a local baker who needs to buy a new commercial oven. The baker takes the loan and hands it straight to the oven manufacturer to pay for the equipment. The manufacturer now has 9,100 rupees in revenue, which they promptly deposit into their own bank account. But the financial system doesn't see this as the leftovers from your original deposit. It views this incoming cash as a completely new 100% deposit. By simply moving through the economy, your single physical deposit has generated a separate asset that the next bank can use to start the process all over again. This second bank applies the exact same 9% rule. They lock away 819 rupees in reserve and lend out the remaining 8,281 rupees as an auto loan. Deposit, reserve, loan. The cycle repeats over and over. Through this fractional mechanism, your initial physical 10,000 rupees can legally multiply into up to 100,000 rupees of new digital credit across the broader economy. So, while your money is out there expanding the economy, who is capturing the profit? You are safely earning your 4% annual interest. Meanwhile, the banking system is collecting 10% from the baker, 12% from the car buyer, and up to 30% from a credit card user further down the chain. The mathematical difference between the 4% they pay you and the double-digit interest they charge borrowers is called the net interest margin. By lending to thousands of different businesses and consumers simultaneously, the massive revenue generated by this margin easily absorbs the financial hit if a single baker or car buyer defaults on their loan. But this hyper-efficient wealth machine has a catch. The digital balances displayed on customer accounts vastly outnumber the actual physical currency sitting in the vault. The entire system relies entirely on human psychology. If public confidence breaks and every depositor rushes to withdraw their savings on the exact same day, the bank faces an immediate crisis. The institution only kept that tiny 9% reserve on hand. The other 91% is physically trapped in commercial ovens, cars, and thousands of other local business investments. They cannot instantly liquidate an entire economy to hand you paper cash. When this sudden panic and evaporation of liquidity strikes, it is called a bank run. Because a panic like this can destroy a major financial institution in days, modern banking relies on government interventions to guarantee safety. Mechanisms like deposit insurance act as an invisible psychological shield. By guaranteeing that everyday depositors will get their money back even if the bank fails, the government keeps the public calm, preventing the panic that would otherwise unravel the fractional system. Your smartphone balance reflects digital money actively turning the gears of the global economy, leaving the bank to act as a sophisticated toll booth that manages the traffic and takes a cut of every passing car.